Supermicro is down nearly 20% as I am recording after the company reported earnings. The stock is sitting at below $500. Year to date, the stock is still doing amazing as it is up 73%, but from its year to date high, the stock is down nearly 58%. So in today's episode, I want to cover everything that kind of really is causing this massive sell-off for Supermicro, especially dealing with its overall margins. Now, if you're watching this video to just get a quick answer if you should buy or sell Supermicro computer, this is not the video for you. But if you're just looking for more information, more data so you can make that decision yourself, then this is the video for you. So let's take a closer look in today's episode.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so I have this great presentation here for Supermicro, and we're going to take a closer look at all the headwinds and challenges the company is facing, why margins took a huge hit, what are some of the things investors should know, what are some of the bearish cases for the overall stock, and also maybe what are some of the overall growth potentials. So first, headwind and challenges. Here in quarter 4 of 2024, Supermicro Computer faced several headwinds and challenges that impacted its operations and financial performance. These challenges include margin pressure, which in my opinion, I believe is the biggest reason the stock sell off. We also saw supply chain constraints and short-term impact on profitability. So like I mentioned, I think margin pressure was the biggest thing causing the overall stock to drop. So Supermicro faced significant margin pressure in quarter 4, with gross margin declining to 11.2% from 15.5% a quarter ago and 17% the same quarter last year. And this is one thing that we all know is the AI server market is a huge competitive space. And Supermicro has mentioned that they are going to keep in line within 14 to 17%. That is their range. But we can see this quarter was a huge loss. But now let's try to understand why this margin dropped. So the first thing they mention is higher mix of hyperscaler data center business. So we're going to see in a bit, but they did get a huge hyperscaler data center customer. Unfortunately, while this comes with huge revenue boost and huge kind of outlook, it does come with the negative side, as usually hyperscale data centers are ones that have very low margins compared to the enterprise and compared to your smaller data center business. The second thing that caused these kind of margin pressures was expedited costs for DLC, or their liquid cooling components. So there was a supply constraint and they needed to pay for faster shipment and get them manufactured faster, which obviously hurt them in the short term. Third is that competitive pricing that we keep talking about to win strategic new designs. And finally, higher initial cost in wrapping production of their direct liquid cooling AI GPU clusters. So a lot of things happening here, and the real thing is, are these going to improve over time, or is this the same story we're going to hear every quarter? With the stock dropping right now, it seems like investors believe this is going to be the same story told in future quarters, and that's why the sell-off happened. But we can see from their CEO, Charles mentioned, our quarter 4 operating margins is 7.8%, which is lower than what we expected due to the higher mix of hyperscale data center business and expedited cost of our DLC liquid cooling components in June and September quarter. And if you are enjoying how thorough I am going with this Supermicro information, this is the type of information I provide in my ebook, the Semiconductor Earnings Insight for this quarter, where I cover a lot of semiconductor earnings. I think right now it already has over 25 companies that have reported earnings, and I'm adding more on a weekly basis. Now, the great thing is it is a living document, and if you do purchase now, you will get the updated versions when they come out. So make sure to check that out at moresemiinvesting.com. I also have another ebook focused on the overall semiconductor market. If you purchase both books, you get $20 off. So I hope you guys enjoy it. Take care, have a good day, and see you next time. Now, there are some ways the company is expected to recover on margins. Management expects margins to gradually improve throughout the fiscal year of 2025, which is starting off right now. They anticipate that the short-term margin pressure will ease and return to normal range before the end of fiscal year of 2025, especially when their DLC liquid cooling and data center building block solutions start to ship in high volume later this year. So not only did we see weak margins this quarter, but based on what we're hearing from from management is this kind of weak margins might continue to happen at least for the first half of this fiscal year until things start to ease up. So this is one thing that is definitely kind of scaring investors off. Now, like I mentioned, their target range, the company aims for gross margins of roughly 14 to 17%. Some of the factors that are expected to help margin recovery is A, the improved manufacturing efficiencies, especially in DLC productions. B, their new facility in Malaysia coming online. C, introduction of higher margin data center building block solutions. And D, potentially pricing improvements as supply chain issues resolve. Here we can see from David, which I believe is their CFO, mentions that they had to ramp up their supply chain. They paid a lot of expedite costs and higher supply chain costs. So I think as the supply chain improves, we expect those efficiencies to now come back out, but they impact us more than we had expected. Now, obviously, this comes with uncertainty. While management expressed confidence in margin recovery, there's no guarantee that this will happen as quickly as they hope. If margins remain depressed, it could significantly impact profitability even with higher revenue growth. And what's the point of making more money in revenue if you're making less money overall on the bottom line, right? So this is what's really scaring investors right now. Now, the risks to margin recovery are one, the continued high mix of lower margin cloud service provider business, and we'll talk about that in a bit. Obviously, ongoing supply chain pressure, and finally, competitive pricing pressure as well. Now, if we take a closer look at supply chain constraints, the company experienced supply chain bottlenecks, particularly for direct liquid cooling components, and some of these components created about $800 million revenue to be missed out this quarter, which actually got shipped out for the July quarter, which also reduced their earnings per share. So this is one of the main reasons the company missed on earnings per share, because they did have to push out some of the revenue for later in the upcoming quarter. Now the company and the CEO believes that this will be more short-term pain. They mentioned that their long-term investment impacts short-term profitability, but they position them for future success by providing a sustainable competitive advantage and necessary economics of scale. So now we really understood what really impacted margins, and we're going to go a little bit more in depth in some of these other solutions. But I want to hear from you. Do you believe this is definitely kind of a one-time thing that we might experience just the first half of this year, or are margins going to continue to be hit? Like I mentioned, one of the big reasons here was the cloud server provider, and the other thing was the supply chain that are definitely impacting margins. And those are two that can kind of get fixed over time. So as we saw earlier, hyperscale cloud server providers are low margin business. The CEO mentions that they are going to be selective when kind of continuing to grow here in the large cloud server provider business. As we mentioned, those come with lower margins, but Ling mentions that they are fully ready for large-scale data center customers, but will be selective. So that's why we foresee only $26 billion to $30 billion in revenue for this fiscal year. If we try to be more aggressive in a large scale, our growth can be even faster than that. So right now, it seems like the CEO is trying to manage a little bit of both things. They want to grow revenue, and that's why they're going with the cloud server providers or these hyper cloud server providers, but they're also trying to balance profitability, because if they focus too much on these large scale data centers, profits are going to take a bigger hit. So instead, they want to be selective. And as we can see with the results of the stock price today, market doesn't really only care about revenue growth. They're also worried about profitability, which makes perfect sense. Now, when we take a closer look at supply and demand dynamics, Supermicro, like we saw, had huge component shortage, mainly those focusing on DLC, which is their liquid cooling components, affecting their ability to meet demand. We could ship more if it was not for DLC liquid cooling, and this obviously impacted overall revenue. Regardless, they had to expedite costs to meet the demand, and that incurred higher costs to kind of get these components. And we can see here that they paid a lot more for that, which obviously increased the pressure on margins themselves. Now, Supermicro talks a little bit about its competitive landscapes and some markets that they believe they can grow. So Supermicro faces a lot of competition here in the AI server, and that's why we see kind of those pricing wars. We have companies like Dell Technology, HPE, Lenovo, IBM, Inspur, Cisco, and the list goes on and on. But one market that they believe they can grow in pretty fast is going to be the DLC, which is direct liquid cooling. The CEO mentions that for June and July, in that 2 months, they shipped at least 70% to 80% liquid cooling compared with the overall liquid cooling in the world. So for liquid cooling, they have at least 70 to 80% market share right now. Obviously, that will change as the other players also push their liquid cooling solutions, but right now we can see that Supermicro is the leader. Now, in forms of competitive pricing and new design, the CFO did mention that Q4 non-GAAP gross margins was 11.3% versus 15.6% in Q3 due to product and customer mix, like we saw that huge data center customer, and focus on winning strategic new designs with competitive pricing and higher initial cost in ramping productions of new DLC AI GPU clusters. So as they get better with this DLC solutions, we are going to see margins improve over time. Next, I want to take a closer look at some of their financial strategies. So the company did increase their capex. They increased capex for this fiscal year to $137 million versus $37 million a year ago, mainly to invest in more properties, more plants and equipment, including their Malaysia plants. Now, obviously, this is a business where you need to keep fronting cash to kind of buy GPUs and to kind of buy all these data center solutions. So they are still impacting at a negative free cash flow market. The company did increase their overall debt. The CFO mentions that the Q4 closing balance sheet position was 1.7 billion, while bank and convertible net was 2.2 billion, resulting in a net cash position of negative $500 million versus a net cash position of positive $252 million last quarter. Now, some technological advancements here. The company did mention that they're going to focus heavily in direct liquid cooling and data center building block solutions. They are targeting for roughly 25 to 30% of the new global data center deployment to use DLC solutions in the next 12 months, with most deployments coming from Supermicro. So while we know that not every single data center or server is going to go direct liquid cooling, it seems that at least 1/4 or 1/3 of them are expected to go direct liquid cooling, and Supermicro believes that they will take a good portion of that overall market share. Obviously, that market adoption can slow down, and if it does slow down, that could continue to impact the company's growth projections and the company's margin hits. Now, the company did give us aggressive growth targets. They expect revenue to be roughly 26 billion to 30 billion for the fiscal year of 2025. In my previous episode, I mentioned why I believe that's great for a company like NVDA, but and it's also a great revenue growth here for Supermicro, as analysts were expecting somewhere around 23 billion. Now the question is, hey, look, what's the point of growing revenue so quickly if you're just going to lose out on margins? The other thing is, this is a huge rapid growth, almost 100% on the top end, and growing at these levels can be challenging. So this may lead to operational issues or mixed expectations if not executed perfectly. So that can also be seen as a bearish case if there are some hiccups in the short term within the next fiscal year. Now, there are some additional informations that investors should be familiar with. First is the company did announce a 10-to-1 forward split that's happening on October. Second, the company is building up a huge inventory buildup. Their Q4 closed about $4.4 billion in inventory, so that can obviously be risky. Any execution risk is also something investors should know. This company is expanding rapidly, expansions like facilities in Malaysia. They're also expanding rapidly into things like DLC, into the AI market, and any of these can see some form of misses due to technological advancements. Obviously, the competitive pressure, macroeconomic risk, and the working capital pressure. At the end of the day, this is a business that you need to keep flowing cash to be able to keep growing inventory, to continue to selling, and that's one of the business that I'm not too excited about. So I hope you guys learned a lot in today's episode. Like I mentioned, today I just really want to showcase why Supermicro was down, and I think this video hit every point that investors should know about. If there's anything I missed, feel free to let me know on the comments below.